Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today we're talking with Brent Kochuba. How you doing today, Brent?
I'm doing great. Thanks so much for having me on.
Yeah, glad to have you on the show. Really wanted to bring you on because a lot of stuff that you talk about, I think, is going to be priceless for a lot of our listeners right now, given what's going on in the world. So why don't you tell us a little bit about your background to start, so people can kind of understand who you are?
Sure, I'm going to give away my age here by talking about my background, I guess, but I've had about 20 years of sell side and buy side experience, almost all of that on the derivatives desks at a couple different banks, Credit Suisse and Bank of America, namely, and then I was with Wolverine, who's an options market maker. I then went to a family office, and when January 2020, the pandemic hit, I launched Spotgamma.com, and what we do is we analyze the options market to forecast how that may impact the underlying equity and indexes.
Okay, cool. So tell us a little about your side on the buy and sell side. Well, first of all, how would you characterize derivatives? Because a lot of listeners may not know what those are.
Yeah, it should be very specific there. So I focus almost exclusively on the U.S. options market. So that is options on equities and indices, with the SPX, S&P 500 being kind of the bread and butter there.
Okay. So tell us a little bit about that side. Like what was that like doing that? Were you trading all the time, or what was it like? What'd you learn?
Yeah, so I had a pretty unique experience, I think, because I started on as a broker on the program trading, which is baskets of equities, and then we went into trading electronic options and derivatives markets. So I got a real understanding of the microstructure, basically, of how the exchanges operate and how funds like to trade and the like. And what you could really see is that the options market was, this sort of alternative way that a lot of people trade, not through different strategies, but just ways to get leverage, right? Not only to hedge. I think a lot of people think of options primarily as I'm going to buy a put to hedge my risk, but there's so many other ways that you can invoke leverage and express a trading idea through the use of options. And not only that, the other thing that's been fascinating over these kind of 10, 15, 20 years I've been doing this is the growth of the options market and how tied to technology that's been, right? As the electronification, so to speak, of trading has hit, and commission-free trading and the like, the growth of options trading has accelerated, and the impact of that options trading is much larger on the underlying stocks and equities now.
So what do you think of that impact? Because I know the options market has changed a lot in the last, whatever, 30 years, and I think, people who haven't been around probably don't really appreciate it. But, tell us a bit about how that's changed. And is the change going in a good direction, or is that going to cause more problems?
Yeah, this is a fascinating topic because essentially what I did is I worked for a family office for close to 5 years, and I exclusively looked at the S&P 500 index options complex every single day. And I came to understand that the way that options were positioned in the S&P 500 could really dictate and oftentimes have a massive impact on the way the index itself traded. And there are trillions of dollars linked to the S&P 500, and so I think at that time a lot of people had a hard time believing or seeing the idea that the options could have such a big impact on the market. And that was, really coming into 2020. And when we launched Spotgamma, my primary job was trying to convince people that the options market could really drive stocks, right, or an index. And then you fast forward sort of into 2021, and meme mania hits, and you get gamma squeezes, and that becomes such a ubiquitous term, and suddenly everybody suddenly understands the impact that options can have almost overnight. And so, my sort of job, so to speak, changed from trying to convince people that options could impact the market to sort of highlighting where that is taking place, kind of in real time. And again, when you bring options in the market, options are leverage. That leverage can be used somewhat, quote unquote, responsibly, or we can get over levered, right, as we saw so often in 2021 in particular, and that can cause a lot of volatility and chaos in markets.
So are you still seeing a lot more leverage now than we have, decade ago?
It's so really it was 2019 into 2021 where I suppose it's the retail component really picked up. And there was obviously a lot of deleveraging that took place after the financial crisis. And I think, you can look at Dodd-Frank and see that there was just a drawdown in the amount of risk that banks could take, and I think a lot of that tied into the derivatives complex at large. But when you forward into sort of more recent times, you had the pickup in retail trading, which brought a lot of volatility to the market. But what we're seeing now is that the retail trading complex has come down quite a bit. In fact, data that we have just as a week ago suggests that retail call buying is at lows now that sourced from before the pandemic started, March of 2020. So that retail trading, options trading component is now somewhat out of the market. And what people are mostly focused on, excuse me, at this point, are puts, right? And from our view, a lot of the day-to-day changes in the way that the market is trading is tied to how puts are trading. Are people buying them? Are they selling them? Are puts expiring, et cetera? Because everyone is focused on hedging that downside and protecting themselves from tail risk in this environment. And so that is really, from the options perspective, what is really impacting stocks.
So, yeah, you mentioned a bunch of things I want to touch on. So you talked about a gamma squeeze. So can you explain that to listeners for those who don't know what that is?
Absolutely. So the idea behind the gamma squeezes that were, so prevalent in 2021 in particular was this idea that when a lot of call options are purchased, generally it's market makers that are buying those options. So if, Kirk, you were to buy a call and I'm a market maker and I sell you a call, as a market maker, I'm now short a call option. So if a stock goes up, that's going to hurt my P&L, right? That's a risky proposition for me. So the way that I offset my risk would be to buy shares of stock. So every single time that, Kirk, you go out and buy a call, I'm selling you that call, so I need to buy some stock. Now, if a whole bunch of people get together, say like on Wall Street Bets or another internet forum, and everyone agrees to buy calls at the same time, say on AMC or GameStop, well, then I'm, as a market maker, selling, thousands, if not hundreds of thousands of calls all at once, and I need to start buying stock in order to hedge myself. And if you look at sort of the way that the options risk lays out, the higher the stock goes, the more stock I need to buy as a market maker to hedge myself. So a gamma squeeze is essentially the term used to explain that behavior, right? That as the stock goes up, if I'm short calls as a dealer, I need to keep buying stock, and that is what can squeeze the stock higher. Again, it's leverage, right? You're getting leverage by buying a call, but I'm short, right, on the other side of that leverage. As a market maker or as a dealer who's trading in these options.
So so that's great. I appreciate that. So what you're talking about, so if somebody's selling a call option, a dealer is, they're buying the stock to cover, their risk. Yeah, but what if the stock sells off?
If the stock sells off, then the dealers can sell back those shares of stock, right? Because the calls, as they lose value, mean that dealers can then sell back shares of stock, which means that in theory, what's really happening here is you can think of it as volatility, right? Because if the stock jumps up, then dealers and market makers are buying tons of shares of stock. And then if the stock starts to turn or those call options start to decay, right? Because there's implied volatility, there's an extra dimension to measure here. So as calls expire, or if calls, as calls decay, or if calls expire, then dealers can sell back shares of stock. So that's why these options expirations are very important, because as you know, when options expire, suddenly that dealer risk goes away, right? Because options have expired and they're left with a bunch of hedges that they need to close. So there's a cycle, so to speak, to a lot of this. But you are right in that your original point was that if the stock starts to go down, calls are decaying, which benefits dealers if they are short calls, and they can sell shares of stock, which can pressure stock lower. So that's where the sort of invokes volatility. The hedging of these positions invokes volatility.
So one thing that comes to mind is, it sounds to me, I go back to like George Soros talks about reflexivity. And it sounds to me like, this buying creates more buying. So it's this kind of self-reinforcing cycle. No matter which direction the market's going, it self-reinforces that direction. Are you seeing that more now than it was 20 years ago?
Certainly I would say more than 20 years ago, at least to the upside. The same phenomenon works to the downside, right, with put buying. And I think that's the more traditional way in which you'd see it. In that it worked, Kirk, if you come out and buy puts and everyone's concerned, right, that Russia's attacking Ukraine or whatever it may be, the more people that buy puts, the more short dealers and market makers are puts. And obviously the market drops and you're short a put option, that's not a good position to be in. So you hedge yourself by selling futures, typically in the S&P 500. This is the reflexive cycle that you adeptly brought up. As the market's going lower, then those puts are gaining in value, and dealers have to sell more futures to remain hedged, and that pushes volatility to the downside, which freaks more people out, right? Generally, you'll see the VIX will jump higher. People get more scared about the market crashing. They buy more put protection, and you can see how that's a reflexive cycle that can feed upon itself, right? And that can often really drive the market lower. So that phenomenon is something that has been around certainly from the great, the GFC forward. Um, and that is so last year was all about call gamma squeezes, right? But now it's really about the put side of the equation and how that reflexive feedback loop is focused on market prices going lower.
Okay. So, you know, I guess when I'm looking at these kind of markets that we see now, they're I'll call them very different this year than they have been for the last, I don't know, you could argue 20 years or so.
Yeah.
And what have you seen that is different now? Like, is there anything that's fundamentally shifted, or is this just like the inverse of what was happening for the last 20 years?
I think there are a lot of there's a lot of structural changes in the way the market changes trades, and I think that is because of the electronification of markets, and also I think the consolidation of liquidity providers. So if you just look at the options market at large, just as a rough example, whereas there used to be probably a couple of dozen different options market makers, and there was a big floor trading pits. If you remember the 1987 movie, Wall Street, where everyone's calling down the phone, that doesn't, by and large, that doesn't exist anymore, right? There is a pit in the S&P 500 and a few of those other, but it's a fraction of what it used to be, and because of legal and compliance, reasons, I think a lot of it again tied to Dodd-Frank and the like. There are now really just at most 6 big market makers in U.S. options, and Citadel itself, for example, is like half of U.S. options flow. And so my point there is that they control so much of the market, and if they, just a few players start to really withdraw liquidity, then suddenly that can leave a big vacuum, right? I think in general, you want to have a robust market, two-sided market with lots of players on both sides, and a lot of players who are different entity types, right? If you just have, just market makers or just banks, just positioned there, then banks by and large, when their risk limits gets full, well, if Bank of America's risk limit is full, then JP Morgan's is probably as well, or if Citadel and Susquehanna don't want risk here, then Wolverine and probably other market makers don't as well. So you get fragmented liquidity. I think that is very, I call transient, and that I think creates a lot of volatility. And then also, again, what just tied back to the Dodd-Frank issues is that banks were just a huge liquidity provider, and obviously that was that caused a lot of problems in the Great Financial Crisis when their risk got kind of out of control. But now there's not that same entity to offer liquidity, I think, in times of stress, and everyone just relies on the Fed now, right? Whatever the Fed does and whatever the Fed says, or if the Fed is in QE or QT or raising rates or lowering rates, I mean, that just dictates liquidity writ large. If you go to the CME website, there's a very interesting tool called the CME Liquidity Tool, and you can flip through the different futures types, right, from everything from oil to cattle to E-minis, and you can see that in late last year when the Fed started to talk about raising rates, liquidity suddenly in the E-minis, this is the S&P 500 index options, index futures, probably the most active futures complex in the world, liquidity just started shrinking. So that's the depth of book. That means if you want to trade, you got to pay more spread, right? You got to have more impact to get your order filled, and that creates volatility.
Yeah, I mean, it brings up this question. I know it's a while ago. I think it was 2010 when we had that first flash crash.
Yeah.
I know the explanation, but to me, it seemed like liquidity just disappeared. Like whoever were using at the time, the black box systems that people were basically providing liquidity, they just shut them off, right? And it was like there was no liquidity at all. We haven't really seen that necessarily since, but I wonder if we're going into this kind of recessionary bear market, if we're going to see stuff like that again, and what prevents that from happening again.
I think it's a big risk. I mean, a lot of the reason, or a lot of the times where you'll see, especially in single stocks, the volatility jump higher, right? And in this case, it was when Tesla was going to 1,200 at the end of last year, or GameStop went to 400 or 500. A lot of that wasn't necessarily a symptom of uh, demand, really, as much as a symptom of liquidity providers backing up. So if the spread suddenly widens out, 30 bucks in Tesla's stock, right? The bid ask spread, and you got to trade because you're getting a margin call. Well, guess what? Someone's going to pay that $30 spread, and suddenly things are going to hit. The stock hits escape velocity, so to speak. So a lot of these big moves are, I think, a function of poor liquidity. So yes, you're not getting a 2010 style flash crash, but I would say that that is an equity. In equities, we've seen many flash crashes, right? And certainly in commodities over this last quarter, we've seen, I mean, the nickel, right, and some of these other products where it's all the same phenomenon, right? Liquidity evaporates and price goes through the roof for no other reason than structural problems with the way the market is trading, right? Not credit issues. I mean, I guess in the Chinese situation there with nickels, it may be a credit. But my point being that, it's a function of people backing away, right? As opposed to like, this guy just went bankrupt and now equities are going to trade down 10%.
Okay. So, I guess one question that kind of comes to mind is, right now people are wondering like what's going on in the markets, and how should people view these markets right now, considering we just had a 40-year bull market and everything. Like, how should people be looking at this market? How should they be investing in this market, at least from a high level?
Yeah, and Kirk, as a wealth advisor, I'm anxious to hear your sort of feedback on what we look at. So I focus, exclusively on the options market, which generally has a 30-day window in time. And what's interesting about that is if you look at significant lows in the market over the last 2-3 years, they all fall on the third Friday, typically of a quarterly month. So think about December of 2018, March of 2020. We just had a big options expiration this past June. And that often coincides with the removal of large put positions in the market. And if you look at a chart list, again, you can look at the third Friday, you'll see that when put options are removed, those are downside hedges are removed, suddenly you get this, again, reflexive bounce in equities. And typically what's happened, historically what has happened, is that in the big lows are December of 2018. If you remember, there was the Christmas Eve bounce, basically, where Mnuchin was calling around to the banks and making sure they had the liquidity they needed, right? That was one of the big lows. The second one was in March of 2020. Again, the third Friday of the month. That following Monday was the low in the S&P. But in and around that time, the Fed came out and was, launched the bazooka, right, to kind of cause us this big bounce. Well, we just had an options expiration in June. That was 2 weeks ago, basically, where we had put options that were essentially the same size as March of 2020 expire. And then the FOMC came out, and it was the first time where the FOMC, was not accommodative, right? There was no bull bazooka brought out, no support mechanism there brought out, as in major lows in the past. Now, the market still bounced. We got a 7% rally from June 17th, which was options expiration, until just about a week or two ago. So there was a good bounce there because the options expired, but there's still this uncertainty around the path of interest rates, and that's tied to inflation. And so our base case here is that if you look at, for example, the MOVE index, I don't know if you or your listeners are familiar with that, but the MOVE index is essentially the bond VIX. It measures implied volatility on options for the treasury market, and that is at highs now that rival that of March of 2020, which was obviously a period, to my mind, that was much more calamitous than today. If that MOVE index, which is treasury bond implied volatility, is at all-time highs, that tells me that traders have no idea what the path of interest rates are going to be, and because of that, you cannot price basically assets writ large. You can't price credit markets, you can't price bonds, and you can't price equities because from a fundamental valuation perspective, you don't know what future cash flows are because you don't know what interest rates are going to be, even in the next week. So our sort of long-winded thing here is that when that MOVE index comes down, that tells us that bond volatility is going to come down, and that's going to be the moment at which we think that equities will find a footing and can start to raise. That was a very long-winded diatribe there, but I'd love to hear your feedback, right or wrong, on that view.
Well, I love that. I love that perspective. I'm not sure that I know the future, so I'm not going to try to predict the future. But we do talk a lot on the show, especially recently, about some of the challenges, and that we've had this paradigm shift in the last 6 months. Right, we've had a 40-year bull market in everything. From 1981 until 2021, we had a bull market in everything: stocks, bonds, real estate, gold, commodities, everything. And the only thing that didn't go anywhere was cash, but everything else was up, in large part because we went from, whatever, the high teens rates, I think it was 18 or 20 rates, depending on what you're looking at, down to zero. And, it allowed a huge amount of leverage to come into the system. But now that engine's reversing, and everything we know about finance is going to change, right? It's just, none of us are around. I mean, you said you've been around for a while, but you haven't been around that long. I mean, I was just born in the mid 70s, so I wasn't economically viable and knowing what was going on. So I kind of missed that from a first person perspective. I can read about it, but it's not quite the same, right? Like you've lived through, early 2000s, 2008, 2020. You've seen all this firsthand, so you know what it feels like. You know what some of the factors drive it. But I think the 70s are a very different period, and we're not ready for it. I think the reason, like you said, you can't price anything when the move index is high. I totally see that, because people haven't experienced it. They don't know how to price it. They just assume that, rates are going to go back down just like they have in the last 20 years. But what if they don't? Well, no one's prepared for that. And frankly, I think a lot of people I've talked to, they said that there's a lot of things aren't priced in. I mean, what's the 2-year bond is the 2-year treasury is priced way below what it's going to be in 2 years. And just little things like that. Like everyone thinks we're going to go back to normal, quote unquote normal, in the next 6 months. I don't know how you do that when you have a 7% spread between, the Fed funds rate and inflation. But maybe you have an answer, but I don't know how that's going to close, without some hard interest rate rises.
Yeah, and the yield curve is now suggesting recession, and I think so many people are. I mean, everything now is just a bet on what you think interest rates are going to do, and if there's going to be a recession, which is this kind of funny thing now, when we get like recessionary indicators coming in, the equity market starts to rally because they go, well, interest rates aren't going to go up. So it's like, but that's a recession. Like that's not necessarily good for equity. So this is very weird. It's a bunch of feedback loops that really create a lot of chaos. I think the other thing that's interesting. Sorry to interrupt you. Is that we were talking before we started about the fact that in March of 2020 you had a lot of credit issues, right? The energy complex failed, and things were defaulting sort of left and right, and that caused the stress in the system. And in here so far, other than crypto, stuff has not really started to default. And crypto, say that what you will, that is not like the energy complex defaulting. And so, yes, we're getting this persistent, very high volatility and drawdown. But there's not this sort of event that I think a lot of people are looking for of like, let's just puke and get it over with, right?
Yeah. Yeah, I think the one question that comes to mind, and we'll get back into some of these other questions, but I want to ask you because I'm curious. If I had to think of one question that's going to drive the next 5 to 10 years, it would be, when we go into a recession, what choice is the Fed going to make? Are they going to bow down to the politicians who want to get reelected and say, all right, we're not going to raise rates anymore, even though inflation's at 8.5 and we're at 2. Well, we're going to take a pause and let's see what happens. Or are they going to actually fight inflation? And I think that question is going to drive the market direction for the next 5 to 10 years, presuming that we continue to have inflation for the next 5 years. So I don't know what your thoughts are.
Yeah, I mean, it seems like to me that a lot of the inflationary pressures are, due to supply, right? Whatever they may be. And I think the pandemic, I thought, was really the first thing that shined light on this, that we get so much from Asia and China specifically. So much of what we consume here is from over there. And I think Russia just showed us again, not only us, but Europe, that's where so much of the energy is supplied from. And so you know, it, it really seems like the only way that you're going to fix the issue is either to bring on a bunch of supply, which no policies seem to really be changing to address that, or you just crush demand, and that seems to be the the path of of what is happening now. So there's no easy way out of this. I mean, oil just kind of cratered yesterday and is still elevated, but no one's entirely sure of what that is, and these supply issues particularly in Europe, don't seem to be going away when you look at energy, which I think is the real, biggest core component of inflation. So we're getting like a lot of volatility in these metrics, but the overall trend, just tells you that if you're going to get inflation under control, you got to keep raising these rates, even though there's some noise in the data. But obviously that starts to invoke a whole other, different set of issues. Is how high can interest rates really go here before there's debt servicing problems and whatever else it may be. It's a Pandora's box, I guess.
Well, I guess that kind of leads into my next question of, you'd mentioned with the crypto space, some defaults happening, and certainly the bond market is another place you can, start to see it. But, let's talk about the defaults in the system, because that did happen a few times in the last 20 years. And, I think there's this kind of, this black swan event that everybody knows about. It's not a secret, which means it probably won't happen, but of high yield bonds and that problem just kind of like hanging over people's heads. So, yeah. What does default in the system look like? And then, how can people be thinking about preparing for that?
Yeah. So from our perspective, the most unique sort of feature of the sell-off so far this year is that volatility has not really spiked. So inside of individual stocks, certainly like a Peloton or Zoom or something like that, kind of the ARK type stocks, for lack of a better term, if you're aware of the the ARK funds, all of those have been crushed, right? Just speculative growth companies have all been crushed. They were the biggest recipient of really of capital, right? In the pandemic, all that's been unwound. The S&P 500, though, writ large, the volatility has been very contained. And if you just look at the VIX, the high of the VIX, I believe, still is on the day of the Ukraine invasion. I think it was February 24th. The VIX has not gone higher despite an acceleration of a whole bunch of other issues. And a lot of that is tied to the structural way that people have been hedged. Like you said before, this has been sort of like the most anticipated sell-off, I think, in a lot of ways, for a long time. People started position for this. The Fed told us they were going to start raising rates, and it's just been this grind down lower, right? And that part is not new. What is different is what creates that second level of vol, right? If you look at tail risk, which is hedging a multiple standard deviation, people have different sort of definitions of that. Let's say 3 standard deviation move in equities. If you're really worried about, we wake up tomorrow and we're getting a limit down market, the price of tail risk in this market has actually dropped precipitously. People are not looking for that major downside hedge at this point in the market, at least in terms of the options market. What would change all of that is if people start to worry about defaults. Because if something is going to default, that means that the equity is going to go to zero. And so even if you're a credit investor, you're going to start to look at buying put options in the equity because the equity is going to go to zero. And that would be the second leg at where we think that the volatility, i.e. the VIX, would suddenly spike to new highs and you get something like a 40, 50, 60 VIX, right, if we start to enter that scenario of defaults. And again, it's been, I think, such a slow deleveraging of the economy, of the asset markets or credit markets and bond markets, et cetera, that we haven't had this freak out moment, right? This spasm, so to speak, because it's just been this steady deleveraging in a bear market as opposed to a crash, I guess is what I would say.
It's interesting because I've been wondering the same thing myself as to why the market has been kind of slowly selling off. And while people are individually kind of panicked, they're not really panicking, and the VIX is certainly reflective of that. But the thing I wonder though is you have all these fundamental changes, but let's just kind of move back, like in the last 10 years. We've seen a ton of times where it's sold off and the VIX has gone really high. I mean, withstanding 2020, which is kind of a different event, it was, hit 80. But I think if you look at any other time where there's been a big sell-off, the VIX is, with the exception of one time, I think it didn't. But all other times, I think it's spiked. And I guess I'm just wondering why it's why it's not there.
Yeah, I think it really ties back into this credit, the credit issue. I mean, the biggest spikes by far were in 2009, the Lehman bank defaults, right, and then again the pandemic, as you mentioned in March. And so when the market is well hedged, and that's what I think what was really happening, people bought a lot of put protection in late 2021, and they've rolled that put protection forward. So when you're well hedged, that means that you don't necessarily have to freak out about selling into drawdowns. And I think the other thing that's happened here that's been a little bit unique is that there's been a few sectors in the S&P that have done well. And so you get a lot of rotation inside of equity. So yeah, you're going to sell speculative growth, but energy's done pretty well, and healthcare I think is doing okay, or you may find some other sectors where you can kind of rotate. And there's also been just, I think it's a deleveraging as opposed to like a margin call scenario. What I mean by that is that I can reduce my equity allocation if I need to. But the other issue, the other side of that coin, and this is something that you could probably speak to pretty well, is that if I need to sell bonds, I can't just sit in cash, right? If you're a big fund manager or even a wealth advisor, right? So you're going to have to sell out of bonds and rotate into equity. So I think there's that other piece of the pie there, right? Where some of it is just asset allocation, like what is the lesser of two evils, right? Is it owning some S&P here, or is it keeping the 10-year where I know rates are going to go up and my bonds may get crushed?
Well, I think, yeah, that's actually a great point, because I think people don't really appreciate that in the past, that you could always rotate into bonds and now you got nowhere to go. So,
Yeah.
I mean, we like cash. I know, as a wealth manager, we're not afraid to go to cash because sometimes that's the only place to go.
Sure.
Especially now, which I think has thrown a lot of people off. I mean, when you have stocks and bonds going down 20% plus in a year, within the first, what was it, quarter or close to quarter, 4 months that happened. I mean, that's crazy, for
Yeah.
bonds to do that. But, one thing, we talked about earlier, you kind of alluded to, is, using options to predict moves or to get accurate pricing in equities. Now, this is something I've always been fascinated with, and I hear very few people talk about it. But can you talk a little bit about how that works, and why this is kind of a good method to to look at potential moves?
Yeah, absolutely. The easiest thing that you can remember is called the rule of 16, and you can apply that to what's called options implied volatility, but you can just apply it to the VIX, and I think this is always kind of a useful just barometer of what the market's anticipating. So the rule of 16 just says if you take the VIX and you divide it by 16, that will tell you the estimated daily move in the S&P 500. So if the VIX is around 30, then the market's more or less pricing in a 2% daily move for the S&P 500. So if you want to say what is the options market, how much do traders expect in terms of daily movement, then you can look at 2%. So that, if you compare it to realized volatility and the way the market is moving around, you can say, okay, realized volatility, that's how much is the market actually moving, is also right around that 30 level. So as I look on the screen, the VIX is at 2750, and 30-day realized volatility, which is how much the market's moved over the last 30 days, is right around in that same area, that 27 level. So what that's essentially telling us is the options market is just expecting more of the same out of the equity market here. If the VIX spiked to 35, 40, 50, et cetera, well, you just use that rule of 16 to say, okay, now the options market is pricing in an even higher move, right? An even greater move. And so what essentially this is telling you is, again, how much volatility is the options market pricing in? How much downside protection do traders want? The fact that realized volatility and the VIX are essentially trading at nearly the same level is another way of telling us that no one's really freaked out here about a 5%, 10% drawdown, in quick succession, that limit down kind of day. And obviously you can get 1% moves each day lower, right? This controlled demolition, I call it. But the VIX in and of itself is not showing any signs of a crazy unexpected move at this point.
Okay. So, I know we've seen kind of the crypto market implode a little bit. I'd say a little bit because it seems to be normal when it goes down 70%. But we're starting to see some of the systems kind of unwind, which is interesting. Are you seeing any big risks in the bond market, that are maybe just overlooked, or any, big risks that are kind of overlooked in the system in general? I mean, I know we can't tell the future, but I'm just curious, like what kind of black swans are out there that people are maybe not really thinking about on a macro perspective.
Yeah, I think it's a good question. I think that I think the default scenario is one that has been a little bit surprising. I think that a Russian default, people would have thought would have caused some more tremors in the market than it did. I mean, they've been able to sort of make their payments or find other countries to deal with, and so there hasn't been that kind of infection into the system. I think a lot of times it's kind of like the butterfly effect, where you get a small default either in crypto or with Russia or whatever it may be, and that suddenly through leverage has implications across of the market in different ways. I think that the crypto defaults are so far been a lot of smaller entities, and it's been a big deleveraging there. I don't know that any, I guess, systemically important entities so far have defaulted. I think there's been a lot of pain felt there, but that that's one of those things that you don't necessarily know until you don't know. I mean, you look at Ecuador and they're invested in Bitcoin and that's getting crushed. I mean, what are the kinds of things that are happening there? So anytime you get an asset blowing up, and I think crypto on the sum has grown to such a size that you just don't know what the links are there, right? In terms of default risk. But basically, when you get defaults is when you get margin calls, and that's suddenly where you get price dislocations. And so that's across the board what we generally look at. I think that spreads are elevating in the credit market, but they're not yet freaking out about things, right? It's kind of like that move index. It's like it's a slow boil higher and higher and higher. And I think at some point, a lot of people think again, well, the Fed's going to stop raising rates, and that will just take a lot of pressure off of the system. But to me, that the fact that there are so many defaults in crypto is one of those things you keep a blind eye on, that will get one of these curveballs that thrown at us that people thought it wasn't a big deal or not important, and suddenly, I mean, there's a lot of things going on in Asia, a lot of protests, and even in the West now, and so I think there's that political kind of angle that you don't know. I mean, you think about the how Thailand created default situations, and in the past, in some of these smaller countries that you don't think are important, Sri Lanka, I think, and some of these other entities, countries, excuse me, are having problems, and you just don't know how that will leak into the system. So people are pretty well hedged, I think, in equities, and they feel pretty comfortable about that. So everything's about what leads people to need that second level of hedging. They're going to pay for hedging and force that second level of price dislocation. And I think it comes from the credit markets, right? And there's a couple of different factors, that could trigger that second round of credit problems.
So one thing that I wanted to ask you mentioned a few things that you watch, but I think as investors, everyone wants to know, like, what can I watch, like, real time? Like, what kind of indicators are good things to look at? Because, I mean, you and I are having a good conversation. This will probably come out in a few weeks, and of course, it'll be a little bit dated, but every day things change. So what kind of indicators do you watch, or what are, which ones are more important than others, given certain ways you're looking at things?
Yeah, I mean, really, the thing that we're watching consistently here is when there's two things to watch. One, I recommend people, and we have some of this on our website. The options market, again, there's big options expirations typically every third Friday of every month, and then on the quarter, so March, June, September, and December are when really big options positions expire in the market. And we think that one of those expirations is going to coincide with a significant low in the market. So right now we're watching the third Friday of September as this place where the options market could exert enough pressure on equities to start a big rally, right? Or at least to fuel a big rally higher. So we mark those dates constantly on our calendar and on our watching. And so that third Friday of every month is, whether you're a wealth manager or RIA or just an average investor trying to make some money, watch that third Friday options expiration. Again, the quarterly ones are particularly important. Circle them on your calendar as times where the options market can drive things. And if you're oftentimes maybe scratching your head, hey, why is the market rallying? Well, it's because all these puts options just expired. And oftentimes those coincide around FOMC events as well. So from a time perspective, a cycle perspective, watch that. we do watch that move index as just a very dirty barometer of how the credit market is functioning, right? Because that is bond volatility. Specifically, that measures the at-the-money options volatility in treasury bonds. And so that's a very, I think, useful indicator for just credit stress, right? And a lot of times people want to try to link the move index to the price of VIX and say, well, the move index is spiking, bond VIX is spiking, but the VIX equity market isn't spiking. And I don't worry about the correlation of those two. I just think that bond volatility has come down for equities to start to rally. So we're really watching for that to come down. And I think that the FOMC meeting at the end of this month, there's a decent sized options expiration. There's a big VIX expiration. So those create movement in the markets. Then you get obviously FOMC on the 27th. So if that sparks the move index coming down, that tells me that, again, just from a very high level perspective, the bond market is taking a breather, right? And I think that will allow dollars to flow more confidently into equities.
Okay. Well, Brent, this is great. I really appreciate your insight here. I know we're running short in time, and we'll have to have you back on because I know the markets aren't going to get less interesting in the next few years. So I think there'll be lots to talk about. But where can people find more about you?
Sure. You can find me at spotgamma.com. We write a daily research piece every morning. We send it out before the market opens, and we just lay out exactly what's going on in the options market and how that may impact equities, both in an intraday and sort of over the next couple of weeks. So you can get a free trial there at spotgamma.com. I'm also at Spotgamma on Twitter. I post a lot of stuff up there.
Awesome. All right. Well, thanks again, Brent. We'll definitely have you back on. Is inflation getting you down? Do you feel like your money is worth less every time you open your wallet? Is shrinkflation frustrating you at the grocery store? Well, I have an answer for you. We're giving away free money. That's right. I said it. Free money. I feel like I'm not doing my part to create inflation. Why does the government get to have all the fun? What could be better at increasing inflation than giving away free money? No, I'm not an employee of the Federal Reserve. And no, I'm not an employee of the US government either. And no, I am definitely not printing it myself. But it's free. What more could you ask? Well, you might ask, is it real? Well, yes, it's totally real. I'm holding it in my hands right here, see? Oh, wait, this is a podcast. You can't see it. Either way, I'm holding it in my hands right now, and I want to give it to you. If you want some free money, go to moneytreepodcast.com/free money to get your free money today. Follow the instructions and I'll send some to you. Enjoy your free money today. I'm not the Federal Reserve, so I only have a limited supply. This offer is good until I run out. Go to www.moneytreepodcast.com/free money to get your free money today. All right. Well, that was a great interview with Brent. I really appreciate him coming on the show. I know he had a lot of great information to share. I wish we had longer for that interview. But now we're in for the panel portion of the show. We have our very own Barb Friedberg. Hey, Barb.
Hello. Happy to be here.
Great to have you. We also have our very own Megan Gorman. Hey, Megan.
Hi, Kirk. How you doing today?
Doing great. And we also have Doug Hagren returning. Hey, Doug.
Good morning, Kirk. Good to see you again. Thanks for having me.
Great. Well, this panel, we're going to have Barb run the show here. We're going to give Barb the mic and let her MC this part of the show.
Great. Well, Kirk, I'm going to turn it right back to you, and we're talking put options, okay? Because that seems to be the type of options. And listeners, don't tune off if you're not totally interested in options, because we're also going to cover more general market information as well, talking about recession investing and other retail investor type suggestions, tips, ideas. So Kirk, tell us, put options, what are they and how can we use them in this market environment, which is a market environment of raising interest rates and extremely volatile, trending downwards stock market and bond market prices?
Great. So I'm going to try to keep this really high level and simple for the listeners because options is one of those things that I could go into the weeds and you never see me again. it's so deep and there's so much complexity there that I think it makes sense to keep it high level. So there's really two types of options. There's call options and put options. Call options are the things you heard about in the news last year and the year before with all the Robinhood traders who were buying some of those meme stocks, and they're buying call options on them. Call options basically means that you expect the stock price to go up. Put options are if you expect the stock price to go down. So obviously, given the market conditions we've had so far this year, people are more concerned about protecting what they have, which is where put options come into play. Now, what put options are is they allow you to take advantage of the price of an asset that is declining. Now, I'll give you an example because I think this is something that everybody can relate to. Your home. So your home, you own it, right? Or at least the bank owns part of it and you own part of it if you have a mortgage, but you own the home and you have fire insurance on your home. Now that fire insurance may cost you $1,000 a year. And let's say your home's worth $100,000, just for the sake of argument, make the numbers easy. So you're paying $1,000 a year to protect your home from fire. Now, for most of us, that fire will never happen. But if it does happen, you've lost $100,000. So rather than taking the chance of losing $100,000, you buy fire insurance for $1,000 a year. That fire insurance is the equivalent of a put option. So you're paying a little bit of money to protect a big asset. So if that asset goes to zero, or even if it doesn't go to zero, maybe it doesn't burn down, maybe it only gets torched. My parents had a house fire a bunch of years back, and the house, like 25% of the house was torched. Of course, if you've seen it, the smoke torches everything. Everything has to get thrown out because of smoke damage. But the point is the house wasn't totaled, but the fire insurance paid back the cost to renovate it and fix it back up to where it was before, which is the whole point. So fire insurance is basically a put option. So let's turn this over to the market. If you have the S&P 500, let's say you're an indexer and you buy the S&P 500 and you have all your money in that, and you think, well, I like buying and hold, investing, but I also feel really concerned about the markets here. I want to buy fire insurance on my S&P 500 portfolio. So I might buy a put option of the equivalence of that portfolio. And so if, let's say, the S&P drops 50%, that put option will protect my 50% from dropping. So you'll basically lose what you paid for the put option, but you won't lose any more in your portfolio. That's the point of a put option, is to protect the downside risk that you can't know for sure. Because if let's say the S&P 500 goes up 50%, well, you have lost out on that 50% gain. And that put option, you'll lose that money, but it's 1% as opposed to 50%, right? So there's a huge difference. And this is why options exist, is to ensure your portfolio against unforeseen events or even events you may be suspicious about, but you also don't want to give up the upside. Because the other opportunity is maybe just sell the portfolio and sit in cash. But some people don't want to do that, right? Maybe for tax reasons, maybe because they just feel that the opportunity is also that it could go up. So an option allows you to, well, it gives you options, right? That's the point of it. So hopefully that gives you some baseline of options, Barb.
Great. Well, that was a very consumable idea, and like to put out there that if you want to learn about options, the Chicago Board of Options Exchange, CBOE, has some wonderful courses. If you don't want to bother, hire a financial advisor that can do it for you, or a fund that can do it. Before we transition out of options, I want to get Doug and Megan's take. Do you use this for your clients? How do you either yes or no in terms of options within your client portfolios? And Megan, I'll go to you first and then Doug.
So first of all, I really liked this interview. I thought Kirk's explanation there was perfect. It's interesting for me hearing about this because you have to think about this in context of risk. So the type of clients I tend to work with have taken their risk in other places, whether it's building a business, whether they hold a large concentrated stock position. So when we're moving things to the portfolio, we're looking to mitigate risk. So I don't have a lot of clients that do option strategies. The one exception is we do covered call strategies. And I have found for my clients that can be incredibly interesting. And that's because a lot of the time when I'm working with a client, they're a senior exec, they can't diversify away from the company stock, and then they finally retire. And so what we're looking to do in a lot of these cases is get prices that they might want, but also clip the dividend and take in some premium in the short term. So for those type of clients, we do a covered call strategy, where basically we sell a call on stock, underlying stock that we already own. We take in the premium. We, if it gets called away, great. We've already been planning on selling it, and we've already had plans to mitigate the tax impact. And then if there's dividend, great. And if the position closes out and the client hasn't sold the stock, the client feels that they've won. I've had one client that said to me, I want to go, I want to use my option strategy to build myself a swimming pool. And we did, but it took time. And so I tell people about this, that when you get into the world of options, you really need to be thinking about how much risk you're willing to take on. And so for my clients doing the covered call strategy, we're mitigating the risk because we own the underlying security. I'm not saying other call strategies aren't great or put strategies. I think options are a fascinating part of the market. But the big takeaway I had with this interview was at the very beginning, he mentioned that he does this for a family office. And I think, and with the S&P index and so on. And what I thought was so powerful about that is this is a person who spends all of their working hours focused on this. And that explains how complex it is. And I can see Doug nodding his head. So I want to hear his point of view on this, because I'm sure he's dealing with some of the same stuff I am.
Yes, Doug, let's hear how you work with options for your clients, general thoughts about, do investors need options? Is it a good idea? What are, or not?
Well, yeah, thank you, Barb. And Megan, I really appreciate that. You saw me nodding because I agree. This is a very complex conversation. Now, you can get really simple with what Kirk was talking about with covered calls and puts, but you can also get really complex. And I hear more and more people out there just doing all sorts of option strategies. And the thing that I always find kind of humorous is the same thing many of you have heard is, oh, this is easy. I found this process, these options I do, and I'm making all this money, until you don't. Options can create significant tax implications. Options have extreme amounts of risk if you are not watching the trends of what can happen and really understand what you're seeing there. So to summarize, I do believe in them and I use them, but they're not necessarily going to be for everybody. Okay. I think that they become something that is more at play when you have a greater amount to protect, right? It's not something you should be jumping in and getting in early in your investing career. Also, like Megan said, you need to be able to watch a lot of details and understand what you're seeing. And there's this old saying, jack of all trades, master of none. You got to be a master at this. So when I use them, if I'm going to be looking at complex options strategies, I will use specialists that do this day in and day out for that component. Now, there are some things that have been packaged out there, things called structured products, like structured notes. I'm not going to get into them here. They simplify the benefit or ways in which options can be used that are being put together through third-party banks and such that can give you some exposure if you are kind of if you don't have a significant portfolio size, but they can still be used there. But in a nutshell, I do think they're important, and I think they are definitely worthy of conversation. But I think it comes back to a bigger thing that I truly believe in, and you've heard me say it before. If you don't like something in your portfolio, you're not diversified. Kind of like this. Insurance is a very controversial thing. You say the word insurance, people cringe, but these are all versions of insurance. Okay. Insurance on your house, insurance on your investments, insurance on your life, insurance on your health. Again, I believe strongly in it because unfortunately there is this thing called the certainty of uncertainty. And when that happens, it's nice to have something that can keep you from losing everything.
Very nice synopsis of pros and cons of options. You're kind of freaking me out when you're talking about insurance because it reminds me how much money I'm just spending on insurance in general. But that's a whole nother podcast. So I also do want to give a little bit of a shout out to Kirk, who can't do this for himself because his practice as a wealth manager, he does a lot of work with options. And I think of the four of us, he is the options expert. So, just putting that out there. Now to transition away from options. Right now, we are at the beginning of August. Word is we are in a recession, 2 quarters of negative growth. That being said, it really can't be determined officially until we're out a little further. But frankly, go to the grocery store and we are in a recession and a crazy, crazy inflationary period. We've been talking about this a lot, but I think we can continue. How do you invest in this type of market to just not lose too much? Hang on to your shirt a little bit. Kirk, I'm going to turn this back to you.
Yeah, I think there are many ways to invest in the market, and if you're on YouTube, you probably saw me chuckle a little bit about Barb's comment about whether we're in a recession or not. Social media, there's a lot of memes out there about whether we're in a recession and who's deciding, and the word salad going back and forth. But look, when you're in a recession, and we talk a lot about this in the there's a lead magnet actually we have on this episode, and we have on our website, the 12 bear market rules that can help you survive and thrive in a bear market. And I think the reason we put that together is primarily because when you're in a bull market, there are certain rules that apply. Buy and hold, buy the dips, bonds are safe. There's a lot of these rules that we've accustomed to using over the last 40 years, and we just assume they're always true, kind of like real estate always goes up. But they're what we call half truths. And when you get into a bear market, the rules are different, and you have to treat them as different. You have to reassess everything you think you know about finance. And it's kind of like the Twilight Zone, because this rarely happens. Bear markets don't happen every day. And it's been 40 years since we've really had a bear market that has affected people in this way. We certainly had one in the early 2000s, but the 70s was really the last time. 70s, pretty much mid to late 60s until like 81 was really the last time that we saw this like it is now. So I think that's more reflective of what we're going to see than the early 2000s. But that was a recession too. And so I think the way you have to think about it is since 2009 until last year, it was growth stocks all the way. It was just, let's put all our money into FANG stocks. Let's just pump up growth stocks, and value investors, as we saw, we interviewed a few weeks ago, they get pushed to the sidelines because they're not performing like growth stocks. So why invest in value stocks when you can just double your money every year in FANG stocks? I mean, it's ridiculous, but that's what happened. And when you're in a bull market, you can get away with things like that. But in a bear market, those rules no longer apply. If you're trying to invest in tech stocks because you think they're down, you might end up losing more money. Because in a bear market, things that tend to do well is stuff, right? It's, industrial stocks, railroads, consumer goods. It's things you buy every day. Like there's certain companies that will continue to do well, whereas in a bull market, you might just be looking for the new technology. But if you think about a recession or a bear market, a recession means that you have less money to spend on the stuff that you normally buy, right? So my food prices and gas prices have doubled in the last year. That means I'm spending less on other stuff. Maybe I'm stretching out my next iPhone purchase another 6 to 12 months. Maybe I'm not buying as many clothes. Maybe I'm not going on as many trips. So all these little luxuries that we might buy in a bull market, in a bear market, people don't travel as much. They don't spend as much on luxuries. They might spend the same amount on stuff they use every day, right? Like you're not going to buy less food. Maybe the quality of food is less, but you're not going to buy less food because you still have to eat. You still got to drive your car to work. So maybe you take the train instead, right? There's certain changes in behaviors that are going to happen in a recession or a bear market that you have to acknowledge. And, for a lot of people, this may not be an issue because you have enough wiggle room in your budget. But for most of this country, they don't have that kind of wiggle room. They don't have savings saved up, and they have to really find a good way to budget well. So if you want to find good investments for the bear market, you need to find things that are consistent, things that are going to be stable. And there's a lot of things you might think, oh, real estate's a good one. It may be. If you buy it right, it certainly should be, right? Because people have to live somewhere. But if your yield you're making on your rental property is 2%, I would argue that maybe you're going to lose money on the value. So I think you just have to really fully think through all these investments. I don't want to steal the thunder. I want to let Megan and Doug talk about some things to invest in. So I'm deliberately not answering the question specifically, but I think there's a lot of things that you can think about. If you think about it differently, that's going to do more for you than just picking whatever's hot today.
Yeah, I mean, Kirk, I think this is one of the things that I think about in this market is it takes me back as a Gen Xer, right? Like the Fight Club rule. What's the first rule of Fight Club? You don't talk about Fight Club. What's the first rule of investing? You always stick to asset allocation. And I really want to nail that down for listeners, because asset allocation, to some degree, it doesn't matter when the markets are going up. All boats rise, right? Asset allocation is strategy to navigate challenging markets. And so this is when you really have to stick to your knitting. That being said, there are diversifiers that you can make sure in your portfolio that help in this environment. So I'm going to throw out one idea that we've been using with clients because I think it's one that a lot of people can get access to, and it helps with further diversification. And that is the concept of private real estate. Now, Kirk brought up the concept of having a rental property, but if we actually go into the investment markets, we've talked a lot about REITs. Barb's talked about it on the show, publicly traded REITs, where you're investing in publicly traded companies like Simon Property Group, Public Storage, Prologis, the industrial REIT. But there's a whole other side of the real estate market that is private real estate. And this is the private markets. And what's interesting is that the US private real estate values have increased in periods of rising interest rates. And that's because they can have strong distributions. So what is private real estate? What is that underlying asset class? That's investing in things like multifamily residential apartment complexes, things like that, particularly in areas where we're seeing significant population growth. You know, when they study what's going on across the US, we've had a huge shift of the population down to the South and the West, like Colorado and Utah. Everybody's leaving California right now. And so as a result, there is more demand in those markets for access to housing. And because the housing market has gotten so expensive, a lot of people are looking to rent. And so private real estate funds that invest in residential housing can be really interesting because they will keep up with the cost of inflation. Other areas that private real estate invests in is things such as industrial rents. You know, we've always been an e-commerce economy for the past 20 years. COVID pushed us forward even more and more of, you know, brick and mortar stores are going away and everything's online. One of my favorite stores is Pier 1. There's no longer a Pier 1 store. My husband's happy about it, but I can still go online and shop there. And finally, you know, you can see, and so industrial rents, we're seeing significant growth and low vacancy. So again, a great hedge. Sorry, I'm losing my voice. And then the last piece is there are certain properties around the country, you know, that are often rented out to management companies, and you can get access to them inside private real estate. So I really encourage people to think through all their different holdings and looking to maybe add private real estate as a diversifier through a fund. You typically a mutual fund that you can get access to it. And sorry for my voice there. I got so excited I lost my voice.
Okay, I want to chime in a little bit. Mutual fund, great idea to get access to private real estate. Although, on the other hand, there are many crowdfunding apps out there for both accredited investors, who are a little bit wealthier, and the normal individual. where you can access private real estate. But I want to give a caution there because I have a concern that you need to vet the founders of these funds because it's pretty easy to set up these type of apps. And I think you run a risk of not knowing who is at the helm. And so there's a lot more risk in these type of easy access, invest with $100, $500 on your phone in private real estate. I like Megan's idea of going with a fund. They have to jump through a few more hoops than these apps companies do. And I think that will give you a little bit more legitimacy to which private real estate vendors make it to the top.
And yeah, Barb, I want to just emphasize before you go into any fund, you should do due diligence.
Yes.
So
absolutely.
Morningstar is your friend.
Yes. Any sort of investing, do your homework. Now, Doug, I want to know what are you telling clients today? What are you changing your investment strategy? What do you think are good investments for today or things to stay away from?
Yeah, that's a great question, Barb, because I think one of the biggest issues that you run into, and again, it's one of the reasons that the people that are really good at this are watching this closely because things turn very quickly, and they turn more quickly than most people, especially sitting in their living room or their office at home working on this, can react to. And the problem with is, what do you do right now? Well, a lot of what might be a good investment for this environment right now has already seen those inflows. Okay. It's already gotten expensive. Here's a great example. Every time we start to go into a negative economy, with some exceptions, so I don't sound like I'm guaranteeing anything, but we tend to see what happens is the bottom gets squeezed first. Okay. So what are we talking about here? So you talked about, okay, we can definitely tell we're in a recession. You want to break Google, type in what is a recession, right? Because right now it doesn't have a clue. And obviously nobody, you listen to the news, you listen to politicians, nobody knows what's going on. But right now at the bottom, because with inflation, minimum wage right now, people on minimum wage are poorer than they were in 1956. Okay. Because their incomes haven't gone up, but the impact of inflation to them has driven that down. So they are starting to cut back and cut back hard, but we're not seeing that. We have a tendency to look at those that are the most obvious, which is going to be the middle class and above, right? And we're still, look at the airports, they're still full. People are still traveling. I can't tell you the number of people I know this year that went to international travel. I'm just looking Facebook, left and right. Everybody's out of the country. People with money are not acting like we're in a recession, okay? But at the bottom they are, and it's starting to trickle up. So what would be where's the reflection of that investments? If you look over a year ago, Dollar Tree, Dollar General, their stock started to rise rapidly. Matter of fact, Dollar Tree is up roughly 66% return over the last year. Okay. Why? Because they start to go away from luxury goods, and they start to go into things that are going to be more cost and economical from paycheck to paycheck, right? But now you would say, well, we're going in a recession, be a good time to buy those things. Well, is it? Because that money's already flowed. So when it comes to what people should be in, this comes back to, like, I love what you said, Megan. It's not investment allocation, it's asset allocation. And asset allocation starts all the time. Okay. So I've said it before, I'm not going to repeat myself, but you have to be investing in those things that are out of favor when they're out of favor, because eventually they become in favor, and you got to monitor that. And that's where it's important to get help if you're not able to monitor these things. But I love building a solid plan is going to have things that have exposure to risk under different environments. You talked about REITs. Traded REITs have a huge advantage of the liquidity of getting in, getting out, and getting the power of appreciation on it. But what's the downside? They're just as volatile as anything in the market because people can get in and get out of them. So now you've got non-traded REITs, which are an option. But non-traded REITs are kind of more like real estate. You're getting into it. You're giving them their money and saying, look, I don't expect to get this money back for 5 to 10 years. Well, if you're in that, you're going to get the income. You're not going to be as subject to that short-term volatility, but you have to understand your own liquidity issues there. And you also have to vet who you're getting into. There's a REIT several years ago that was preparing for baby boomers to go into retirement, right? Everybody, it was going to be this massive shift. Well, 2008 came along and they all started working longer. And this REIT invested in lifestyle activities, a lot of golf courses. Well, guess what's happened to golf over the last 10 years, 15 years? There's not near as many golfers as there used to be. So all of a sudden you're locked into this investment. You've bought this real estate as if you went out and bought it yourself. And now it's hard to get out. So you have to understand there are things, I like things that are exposed to the markets. I like things that are exposed to liquidity times where there's a lot of inflow of money from the government, from the Fed, from low interest rates. I like exposure to things that are going to do better when interest rates go down. I also like things that are more index related or cash related as an asset class, because as Warren Buffett says, look, why do I sit on cash sometimes? Because it gives me options tomorrow. I'm still seeing tons of chatter on Twitter and other areas of social media that buy the dip thing still exists. I think that's helping to stabilize this, because people are like, look, it's down, it's cheaper, let's buy it. And the bottom's here. We don't know that the bottom's here. As Kirk likes to say, we might be in a paradigm shift of things where a lot of these people making this advice have never lived it. In the last 20 years, all they've seen is, look, volatility, it went down, it came back up. They don't know the 70s. They don't know the 30s. They don't know a lot of those things that have occurred. So you really have to balance that asset allocation, not just your investments, but where your money's in the market, where your money's out of the market. Like I said, I like insurance. I like annuities. Some of my best clients right now with the most successful retirement actually have a fairly sizable amount of annuities. As they're getting into retirement, guess what's happening? These annuities are turning on, and all of a sudden they're like, wait, I don't have to sell my assets anymore to live. I have an income stream. They still have all these assets. But you know what it comes down to? And it's the one thing that most people just don't do enough of. Balance. Build balance when you're building your plan, and you will have options tomorrow, just like Warren Buffett says.
Everybody, really great synopsis. And the key with asset allocation is you're not going to have the best performance of the top asset class, but you're also not going to suffer from the worst asset class. So a lot of people are saying international going crazy. I just read in the Wall Street Journal this morning, there are double-digit countries that are facing bankruptcy internationally. Now, does that mean we don't have any international exposure? No, it just means that you might need to wait it out a little and consume the dividends that international stocks are going to give you, because they're really nice and high, and kind of wait it out. One more point for all of you investors out there. Investing is not for short-term monies. And I was on another podcast yesterday about, and I'm not going to say the name, but we were discussing a really popular app out there and getting everybody into investing. Well, be aware that if you have expenses that are coming up in the next year, 2 years, 3 years, 5 years, down payment on your house, wedding, big vacation, do not put that money in the stock and or bond markets, ETFs, because it is too risky. That money needs to stay in cash-like assets, CDs, money market funds, etc. Our last topic we're going to cover today is high yield bonds. We had some conversation about that on the interview, and investors looking for yield get really excited about high yield bonds because you can get extremely good yields. I was looking the other day, like 10, 12%, but there is definitely the risk of default. So I'd like to just find out from our panelists, who of you wants to touch on this subject first?
Barb,
Well, let Doug go first, because we all keep jumping ahead of him.
That's all right. Actually, and I apologize, but I want to rewind it. Just briefly to what you just said, because I think that ties it back to the podcast. What did he say that I think is the one thing that we're waiting on that hasn't happened yet is defaults, right? If those defaults occur, and maybe you've touched on something, the international market might be where that starts to occur. But until we get to this area until those defaults start to happen, we may not see the catalyst that starts the domino effect, right? Because we saw that really happen. It happened in real estate in 2007, and then everything came from there. So I think that's a really critical point you just made. Defaults are something that need to be watched closely. The other thing, and this comes back to the investing conversation you had, long-term thinking. Again, I'll go back to some of these millennial bloggers and millennial Twitters. They've got hundreds of thousands of followers out there. I saw a post the other day. It's like, I don't like keeping cash at all. If I've got money, I invest it. How much cash? Well, if you need something within the next year, maybe that's the only time you keep cash. 1 year. Barb, the rule of thumb is 5 years, and it's been 5 years because lots of things can happen. But again, we have lots of people that have no idea what it's like to go through true risk, as Kirk likes to talk about a lot. There's a difference between volatility and risk. And unfortunately, a lot of the advice that's being given out there, especially at some of the more younger advice givers, is unfortunately tied only to things that we've witnessed in the last 10 to 20 years. And there's a lot of other things that have occurred in history that can come back. So I wanted to address that really quickly. The other thing I wanted to, I did want to get into the conversation of how it works with high yield bonds and some of the real risks that you've got. People are clamoring for liquidity. They're clamoring for yield. They want income. People love dividends. Dividends don't always work. They didn't work during 2008 when the market crashed. But one of the risks that you have right now is when you start chasing yields. Okay, as things get chased, the asset price gets driven up. Okay, it's a simple supply and demand. As the asset price gets driven up, then you have more the return, the yield you're getting off of it gets driven down. Okay, so right now everybody's clamoring for yield because there isn't out there. Look, the government has stopped liquidity, and so what's happening is you're getting less and less and less of what I call a premium for the risk you're taking. Go back to credit cards, right? Let's go back to mortgages before the mortgage crisis, right? You started looking at the fact that people that had terrible credit, and we're starting to see this in the auto loan world, by the way, defaults have spiked on auto loans. The majority, 2/3 of them are starting to get into default. That's scary because there's no regulation around it. And what's happening is now what you're seeing is that you have not charged enough for the risk you're given. Remember, high yield companies or governments, they're high yield for a reason. The same reason someone gets a 30% credit card or gets that 100% interest rate on that 2 a.m. advertisement to give them money because they're in a pinch. They have trouble paying. Now, in a good economy, they might be able to squeeze through. But as the economy starts to shift and slow down, what are some of the risks you run into? Well, the yields are still relatively low. Okay, so all of a sudden that compensation of risk really isn't paying for that risk. So all of a sudden you're not collecting enough to pay for those that start to default. The borrowing costs for companies that have leverage are on the rise. That's going to create more financial trouble for them and lack of an ability to pay those interest rates. Corporate profit growth is already starting to slow. We've got, there's usually, now Kirk can talk about this a little bit more, but flatter inverted yield curves, that tends to spell trouble for high yield bonds. The way I've always looked at it is you tend to find the highest return on high yield bonds at the worst time in the economy. Okay. You're getting paid. They've driven the value of that down. You're getting paid the premium. Now, these companies already have trouble paying their bills and you're not getting a premium for it. If the economy worsens, default, let's come back to what we just said. Default risk goes up significantly. So the best time to get into high yield is typically coming out of a recession because guess what? They made it this far. They've been able to pay their bills. They haven't gone under. And every day things are getting just a little bit easier for them. But right now, we're in the late stages of an economy. Interest rates, just like back in the mortgage crisis, aren't paying enough for the quality of rating and the quality of of default risk that's out there. And I think that if you're chasing yield and you're not getting paid for that risk, be very, very, very careful about what's to come.
Because it doesn't matter if you're getting a 10% yield, if you pay $10 a share for a bond, you're getting a 10% yield and the bond value drops to $3. Well, you've lost 70% of the value of your investment. So Megan, what do you think?
Well, I think Doug did a great job explaining it. You know, you always want to come at an investment in terms of the risks. So since he went through the risk of it, I want to talk about it in context of portfolio construction, right? Which is, if you feel that this risk you're comfortable with, how do you actually allocate to high yield inside your portfolio? And in previous episodes, we've talked about the core complement approach. So, you know, my firm subscribes to the fact that we want to stay typically in the very high credit area, right, of the bond market. We want to take our risk in the equity market. So usually the core investment is high credit quality municipals or corporates, depending on tax rate. And then we complement it with different types of bond funds, international funds, mortgage-backed bonds, opportunistic bonds, floating rate. And you can have a sliver to high yield as a complement to the core holding of high credit quality bonds. So you wouldn't want to see an allocation of 10, 20, 30% to high yields. I'm talking about maybe 2 to 3% at most inside your fixed income portfolio to get participation in that bond, in that asset class. And I think, you know, one of the things in going through the risks that Doug brought up, this is where due diligence is really important. I would not index here. I would want an active manager here who's monitoring credit quality. And when we review bond funds, we are more focused at times, not on yield, but what is the underlying process in how they vet bonds and make sure they warrant investment consideration. So I think between Doug's advice and my advice, you can sort of see what you need, the checklist of what you need to be thinking through to go have high yield bonds in your portfolio.
Hey, Megan, I thought it was always about saving 0.5% on fees that made you money. That's what I hear every time I log on.
Yeah, no, that's, you know, it's funny. I would say one thing. I think investors have gotten savvier about fees, and that's good news. But to your point, Doug, sometimes they prioritize that above other investment considerations. And that's where sometimes they cut their nose off to spite their face. And so you really need to think through it the right way in terms of, I'm paying for protection on the downside risk.
If you want to think like a millionaire, fees are important, but they are down the list of priorities. Most business owners and most successful self-made millionaires look beyond fees to what am I going to get for what I'm paying, not just about the cheapest cost.
Okay, Kirk, I'm going to turn it back over to you, and bond thoughts, wrap it up, whatever you think is best.
Yeah, so I'll be quick here in the interest of time, and then we can wrap it up. But I totally agree with what Megan and Doug said here, because I think you know, when it comes to high yield bonds, they're a very interesting asset class. They act very similarly to equities, but they've got a higher yield to them. So they're attractive in this environment because people are hunting for yield. And hey, I can get 4% of my high yield bonds, which to me is laughable because that doesn't account for risk. But if you're only getting 0 to 1%, it seems very attractive. But I think, you know, one of the things to realize is that they're very highly correlated with equities. So it's a function of what you're really looking for, and are you willing to take the risk to invest in those high yield bonds? I totally concur with Megan when it comes to funds. I think there are certain asset classes that you would be doing yourself a huge disservice by indexing. High yield bonds is one of them. Another one might be emerging markets. And the reason being is the ETFs or indexes are so skewed in the wrong direction. It's not that they're poorly made, it's because they're made to account for billions of dollars coming in. And you can't have $1 billion in every area of the global economy, like emerging markets or high yield bonds. It's just not feasible. So I think you have to be mindful of the fact that there are certain asset classes, emerging markets, high yield bonds, there's a few others, that if you really want to do them right, you need to have an active manager and be willing to pay the fees. You know, I think if you wanted to day trade a high yield bond index or emerging market, that's fine. But if you're a buy and hold, I wouldn't do it. I would focus on finding good managers. So, but I think when it comes to bonds, I think we all need to reconfigure our understanding of how bonds work. I think this is really important, and it's not discussed enough, is that bond markets went through a 40-year bull market. You could not lose money in bonds. It was not really feasible in the last 40 years because as interest rates dropped, bond prices rose. And we all thought bonds are safe because, hey, they've always been safe and they always go up in value. And even if the market crashes, I'm okay, right? Because they have done that for the last 40 years, which is most people's investing lifetime. Unless you're retired, you're 65 or older, you probably haven't experienced a bond bear market. And the 70s was a good indication of that. Bonds basically lost money for a long period of time, over a decade. We haven't seen that. Bonds are quote unquote safe, according to pretty much every industry expert, by the regulators, by everyone. Oh, have your age. The rule of thumb was always have your age as a percentage of bonds. So if you're 65, have 65% of your assets in bonds. Those are all safe rules of thumb in bull market rules. We're no longer in bull market rules. Now we're in bear market rules where things are different. This is one of the things that's different. So if you think you're in bonds and you're safe, you're not. Bonds are just another asset class you can use to diversify, but it's not necessarily safe. So you need to understand the role of bonds in your portfolio and the risks you're potentially taking. Because as interest rates continue to rise, bonds are not going to be safe. They'll cause you to lose money. Now, there is going to be a time where bonds will be a great investment, and that might be a few years out. High yield bonds the same way. I think there'll be a time where high yield bonds is going to be a great investment. 2008, 2009 was a great time to invest in high yield bonds. You could have made, hundreds of percent return or made 10 to 20% yields on an ongoing basis if you picked your bonds right. That was very possible. There were a lot of bonds there that we and others have bought that, did extremely well because the market was hollowed out. It was really low, and you could find good investments that were producing good income continuously, and that continued to grow. I perceive a time, much like in 81, where it was a great time to buy some of these old school companies that Warren Buffett bought, you can look at like Johnson & Johnson or Coca-Cola. That would have been a great time to buy them. And there will be a time in the next, 5 or so years where that will happen again. But until that time, you just have to be really careful about what you invest in because there may be a better opportunity around the corner. So as we wrap it up here, Barb, final thoughts from you.
Fall, bond values go up. When interest rates rise, bond prices go down. So a way to counteract that is to keep your maturities shorter. So shorter term bonds are less volatile to the changes in interest rates. So I am Barbara Friedberg. You can find me at Barbara Friedberg Personal Finance on YouTube and at RoboAdvisor Pros. Bye.
Thanks for coming on, Barb. Megan, final thoughts from you.
Yeah, it's best investing is incredibly boring. It's like watching paint dry. So stick to your asset allocation, do your due diligence, and approach it from a core complement approach. I'm Megan Gorman. You can find me at Forbes.com/Megan Gorman. Kirk, thanks for having me on.
Thanks for coming on, Megan. Doug, final thoughts from you.
Hey, Kirk, thanks. When it comes back to the bond, the last thing you said, it's interesting because I don't know what the guru, not the guru, but the bogleheads, they love talking about how Vanguard, cheap, passive investments. Vanguard actually has white papers out there professing the value of active management in fixed income. They agree that there are strong asset classes where it makes sense. Again, that you could find those through Vanguard's records, but the reality of it is the key thing when you're building your portfolio, it's about asset allocation. It's about balance. It's about things that do well in different cycles. It's about understanding that there are going to be times where they're going to be very favorable for bonds and equities and times in which cash equivalents, and other safe instruments are going to protect you. Ensure yourself through balance in your portfolios. Don't just chase. It isn't all about return. It isn't all about the most return you can get. My name is Douglas Hagren. I am a co-founder of Mergent Group, MERGENT. It's spelled differently, so I like to spell it, but mergentgroup.com. But also one of the key areas in our financial planning is college planning. This is an area that most people don't understand. Most of what you've heard or know is wrong. You are overpaying for college, and it isn't just about the price you get, but it is most importantly about how you choose to pay for college as well. If you don't have a strategy or a plan, you will likely overpay. Give us a call or reach us at procollegeplanners.com.
Thanks for coming on, Doug. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.